I kindly request everybody to put their microphones on mute. Right. So welcome everybody to this webinar on derivatives. I just want to do a quick sound check so that I am certain that everybody can hear me. Could you please quickly type in yes on the chat box so that I can be assured that you can hear me. Right. So I guess I'm getting I guess my sound is audible right now, and everybody can hear me. I guess you guys know the format of this Q&A session, where the way it works is that I'm here to first let me begin by giving an introduction about myself. My name is Asad Rauf. I'm doing my PhD in finance currently, and in this session I'll be taking on questions regarding the topic of derivatives. So the way this works is that you type in your questions on the chat box, and I take up your question one at a time. Make sure that you have a name associated with your chat identification so that I can identify your name. And you ask a question, and I will take up the question and read out the question along with who is asking the question, and I will answer that question. That's essentially how this webinar works. So please go ahead and start typing in your questions regarding derivatives on the chat box, and I will take them one at a time. Please make sure that your name is there when you are typing those questions. So again, let me repeat, the way this webinar works is that you start typing in the questions, and I take the questions one at a time, and I answer those questions. So I have a question from Kanan, and he's asking me on the interpretation of the put-call ratio, and he's sort of asking that what is the interpretation of this put-call ratio, as does a high put-to-call ratio mean there is a bearish sentiment in the market, and does a high or a low put-to-call ratio mean there's a bullish sentiment in the market? So if I understood your question correctly, you sort of try and understand what does the PCR sort of signify. Kanan, so the one thing that you have to keep in mind is that when an option is created, when either a call option or a put option is created, somebody is selling the option, like somebody is writing the option and creating the option, and somebody is buying the option. Okay, so for that one particular option, be it a call option or be it a put option, one particular person has a bearish outlook and one particular person has a bullish outlook. So if it's a call option, the one who is buying the call option, he has a bearish outlook of the particular underlying asset or the index, and the one who is selling the option, he has selling the call option, he has a bearish sentiment on the underlying asset or the index. So similarly, on the other side, on the put side, if somebody is buying a put option, that person has a bearish attitude towards the underlying asset, and somebody is selling a put option, he has a bullish attitude. Now, on one particular underlying asset, if you have more calls and puts, I personally feel, and I can say this as an academic, I don't think there is enough evidence to suggest that the put call ratio can signify whether the sentiment is bearish or bullish. Simply because for any particular option, you have the same number of buyers as you have sellers. Somebody is buying and somebody is selling, right? So for the same particular instrument, that is either a call or a put, you have the same number of people who have a bearish outlook and you have a bullish outlook. Now in certain counters, in certain indices, you will see more call options, and certainly you will see more put options. So I do not think you can back out by looking at the ratio of how many call options are open in that particular counter and compare it to how many put options are open in that particular counter. You can back out what is the trend, what is the whether there's a sentiment is bullish or bearish. I do not think that is possible, because for any particular option you have, when one person is buying and one person is selling, you have the two opposite views of the market. You have the two opposite sentiments who are transacting. That is why one person is buying the option and one person is selling the option. Generally what might happen is that you might have more call options or you might have more put options. One of the more important driving factors is liquidity. If it is the case that call options, it's more liquid, there's a more deeper number of there are more trades happening on the call option side than on the put option side, you might see a little bit of you might see a bit of bias of the trading on the call option side than on the put option side. Okay. Of course, when you are trading in options, there are a gamut of parameters that one has to take care of. For example, there is volatility, there is time to maturity, there is a delta, there is the gamma. So all these parameters are obviously there, and they are different between the call and the put. But what generally tends to happen is that liquidity seems to be an important driver, and you might see a little bit more call options out open than put options, because for that particular counter, call options might have been a little bit more liquid. So my view is that you cannot identify the trend of a particular underlying asset by just looking at the ratio of the calls and puts. So I have the next question is from Varun, and Varun is asking me, can you please give me a brief about derivatives like calls and like call options and put options and futures? Varun, so this is like I can only give you basics about derivatives, and the idea is that derivative is an instrument. It is a contract essentially. It's a contract, or it's in simple English words, it's a bet. It's a bet between two parties on an underlying asset. The bet between the two parties involves a certain payoff. That means somebody will pay somebody something based on what happens on the price of an underlying asset. That is essentially what a derivative is. All derivatives are essentially the same thing. It is a contract, it's a bet between two parties where they agree upon a payoff. That means one party will pay the other when something happens. It might be a continuous payoff, it might be a one-off payoff, a one-time payoff. So this payoff, this bet between two parties, where the payoff between the two parties depends on the underlying price, or the price of the underlying asset, that essentially is a derivative. Now what is a call option? A call option is essentially the right to buy an underlying asset at a fixed price on a future date, right? So I, as a buyer, have the right to buy, when I buy a particular call option from a seller, let's say you're selling a call option. When I buy the call option from you, I essentially buy the right to buy that underlying asset from you at a fixed price at a future date, right? So let's say I enter into a contract with you to buy, let's say, I don't know, Tata Steel shares at 200 rupees per share on the, let's say, 25th of December. Let's say we fixed on that date, and I agree to have an option to buy from you Tata Steel shares at price of 200 per share on the 25th of December. So this is a bet that we entered with each other. Okay. Now on the 25th of December, I find that the Tata Steel price shares in the market are priced at 260. Now remember, I got into this contract with you and I wanted to buy the Tata Steel shares from you at 200, right? So now I see this is a favorable contract because in the market they're selling at 260. I already have a contract with you where I can buy it at 200. So obviously I would want to take advantage of this contract that I entered with you. So the way we could do it is that I could I could pay you 200 and you give me one Tata Steel share, or you essentially give me the difference between the market price and the price that we agreed upon. That is the 260 minus this 200 that we agreed upon. 260 being the current market price on the 25th of December. So you could give me the 60, the difference, so that I can buy it from the market at the market price, and effectively my cost of buying one share would be 200 because you gave me 60. I have 200. I add 200 to 60. I get 260. I can buy it from the market at 260. So effectively, the cost for me was 200 because you gave me the 60. So what happened in this contract? In this contract, you paid me 60 rupees, and this payoff of you paying me 60 rupees was agreed upon. You paid me 60 rupees on 25th of December, and this was agreed upon today. So this is essentially a contract which we signed with each other, and the payoff of this contract was dependent on the price of Tata Steel on the 25th of December. This essentially is a call option. Similarly, in the put option, you have a different kind of a payoff, where you sell something, where you sell a particular stock at a fixed price on a future date. Okay? So derivatives essentially are payoffs, are contracts, are bets, where two people agree with each other, agree on a certain payoff based on the price of a certain underlying asset. That is essentially in brief what I can tell you what derivatives are about. Now, the difference in these various kinds of derivatives is the nature of these payoffs. Right? In call options and put option, in options, the buyer of the option has the right, but not the obligation. So the option buyer has the option to decide whether he wants to execute the contract or not. In a future, both parties agree to buy and sell an underlying asset, buy and sell an underlying asset at a future date at a fixed price. But this contract, this buying and selling agreement is binding on both. Nobody has the option. That is a future. In an option, one side has the option, the other side does not have the option. That's why it's called an option. And because one side has the option and the other side, the seller of the option, has to agree with whatever the buyer of the option wants to do, that is why the buyer of the option has to pay a certain price to purchase this option, and that is called the option premium. So this is essentially in brief what derivatives, calls and puts are all about. You know, derivatives, calls, puts, and futures are all about. Forwards essentially are a different kind, are essentially futures itself, but just that in forwards you have delivery-based settlement. We do not have forwards in the NSE, in the stock markets. We only have futures. So my recommendation is try to understand futures, and you will by default understand what forwards are. Okay, I have a question, and Kannan is asking me then how should we answer the question with regard to an exam point of view. Kannan, could you exactly type in the question so that I can take a look at the question? Otherwise, I'm not exactly sure which exam are you talking. Are you talking about the NSE certification exam? I'm not sure which exam you're talking about. It would be good if you can type in the question so that I can take a look at that. I have another question. I don't know who's asking this question because the name is not there. And he or she is asking me, who fixes the future date of trading? That's a good question. So the thing is that in the stock markets, that is on the NSE and the BSE, it's the exchange which decides the future date of the trade. So the exchange, so let me show it to you. So if you go to the NSE website, you will see that there is this, wait, let the site load. So currently there are 3 futures contracts trading on the Nifty exchange, on the National Stock Exchange. So there is the 29th December expiry, the 25th January expiry, and the 23rd February expiry. So this is the one here. The first one is the 1 month expiry, the second one is the 2 month expiry, and the third one is the 3 month expiry. So these days, this expiry date is set by the exchange. Okay, so the exchange sets the expiry date for the futures contracts because these are standardized contracts. The exchange decides on the expiry date. They also decide on the lot size. Okay, so when you click on this and when the text, so you see this lot size, market lot 75. This is also the one here. This is also decided by the exchange. So exchange for a futures contract, the exchange sets the expiry date and the market lot size, and the trading happens. So that's essentially, answering your question that who sets the future date of trading. It's the exchange which sets the future date of trading, and then buyers and sellers come and buy and sell these. Buyers and sellers will come and buy and sell these contracts. All right. So I have another good question from Sachin. He's asking me, who fixes the option price at the beginning of the contract? So let me take you to the option, option chain website of this NSE. So essentially, so Sachin is asking me that liquid options. All right. So you see that the 8250 call option is now trading at 114 rupees. Okay, 8250 strike price call option. This expires on the 29th of December. This is trading at 114. So when you open this price, and Sachin is asking me who decides this price. Sachin, nobody decides this price. This price is something that is discovered via the price discovery mechanism when buyer is quoting a price and the seller is quoting a price, and whenever you have a match, you have the price. Okay, so this 114 that you see here, this 114 is the last traded price. Okay, that means one buyer and one seller agreed to trade on this particular call option at 114. So different buyers and different sellers will come and quote different prices, and when they come and quote different prices, whenever there's a match between the buyer's quote and the seller's quote, there will be a transaction. That is how the price of the option is discovered. Price discovery mechanism is market where buyers and sellers are marking their prices. Could I request everybody to please mute your computers, please, your microphones. I request everybody to kindly mute your microphones. Right? Okay. So, thank you. All right. So, I have a question from Richard, and Richard is asking me, as we know that option sellers have limited profit and unlimited loss possibilities, how can a seller of the option manage the risk of his trade effectively? Secondly, if the seller follows some methodology to sell the option by calculating the rate at which they feel it will be trading and during the, okay. So, so Richard, this idea that option sellers have limited profits and unlimited loss, this is a theoretical concept. I mean, it is right that an option seller's profit is limited, but an option buyer's profit is theoretically unlimited. But it is a very, very theoretical concept. It has very little bearing on the market. Okay. So, for example, if I go and sell this 114, this 114, this Nifty call option, which expires on the 29th of December. If I go and sell this at 140, my profit at max will be 140, right? And my loss is, as you pointed out correctly, is unlimited. You're totally right. But come to think of it, to make a loss of, let's say, 1,000, a huge loss, to make a loss of 1,000 on the 29th of December, the Nifty needs to be at 9250. Because the strike price is 8250, I want to make a loss of 9250. If I make a loss of 9250, that means the Nifty on the 29th of December will be 9250. What do you think is the possibility of the Nifty being at 9250 on the 29th of December? I mean, it's close to zero, if anything. There are very little, there's almost a 0% probability that the Nifty will be at 9250 on the end of 29th of December. So you see, yes, technically your loss is unlimited if you are selling an option, but that is a very theoretical concept. You're obviously limited by how much the market can move. You know? So don't look at buying and don't look at selling options that, oh, my profits are limited on the downside. My profits are limited, but my losses can be unlimited. Yeah, theoretically, but it doesn't really make much of a difference. Okay? When you're selling options, there are certain parameters that you need to keep in mind. Right? How does this price of the option, this 114, how does this move? What are the parameters which affects this price? Because essentially when you're trading option, you're either buying this this call option or selling this call option or different other call. This is a call option with a strike price of 8250. You can buy other call options as well. So when you're buying or selling this call option, you're essentially trading on this 114. So let's say you buy it at 114, you sell it at 120, you make a 6 rupees profit, right? Now, so when you are trading in options, what you need to keep in mind is that what are the various parameters? What are the various parameters which affect this price of this option? Okay, and the parameters that affect the price of this 114 are something that let me summarize them. So the first thing that affects this 114 is obviously the Nifty. The Nifty is right now at 8261. Here on the top that you can see, the Nifty is at 8261. If the Nifty goes up from here, if it goes to 8361, 8461, 8561, obviously this value will increase. This will become 100, this will become 200, 300, whatever, based on how much the Nifty increases. So obviously, the price of the underlying asset, in this case is the Nifty, definitely affects the price of this option. To keep in mind, definitely. But there are other parameters as well which are affecting this price. Even if this Nifty value 8261 does not change, even if it stays constant, hypothetically speaking, even if this Nifty value does not change over the next 1 week or so, even then this 114 will change. What will cause it to change? The other very important factor that will cause it to change is time to maturity. Today is the 11th of December. This option expires on the 29th of December. So in these 18 odd days, the value of this option will decrease. As we move closer to the expiry, the time value of the option decays. So you have to keep in mind that when you are buying an option, time is always working against you because the price of the option is always falling as you move toward expiry. Even if nothing happens in the market, even if there is no movement in the market, as you move towards expiry, the price of the option will fall. But if you have sold the option, then time is working on your benefit because as you move towards expiry, the price of this option will fall and then you can buy it at a lower price. Okay, so time to expiry is another very important factor that you need to keep. When you're selling, when novice people start trading in options, they always start by buying options because they think you want to buy an option and then it increases and they sell it and they make a profit. But most novices, most beginners forget that when you're buying options, be it call options or be it put options, the time is always working against you. Okay? So this is one thing. Another thing that you need to keep in mind. The other factors that affects this 114, this price of the option, is volatility. Right now, the implied volatility for the Nifty is about 10.73%. This is here on the bottom line. If volatility goes up in the market, then this price will go up. If volatility goes down in the market, then this price will go down. So when you buy and sell options, the other thing that you also need to keep in mind is what is going to be the volatility in the market. If the markets are going to be more volatile in the coming future, then buying option makes sense. Buying either call or put makes sense. But if volatility is set to decline, then buying options can be a bit harmful, and in that case, selling options might make sense. So the long answer to your very specific question, Richard, is that buying options or selling has to do with how do you expect these couple of parameters to affect the price. It has got very to do with whether you are selling or whether you're buying. Well, of course, whether you're selling or buying also has, because that also gives that provides your outlook of what you expect to happen on that particular counter. But don't think that, oh, because there is limited loss, in buying and there's unlimited loss in selling, that's why there should be a bias towards buying rather than selling. No, that is a completely erroneous way of looking at options. Okay, Varun is asking me, can you please explain the strategy of an investor in bearish and bullish markets? All right, so Varun, so there are hundreds of strategies of options. Obviously, I cannot cover all the strategies here, but what I can do for you guys is that I can guide you to a website which has a very nice, strategy, which has a very nice a strategy kind of which explains various option trading strategies. So if I click on this, you see that there are all kinds of strategies here, and I would recommend everyone to kind of whatever strategy you're interested in, you can click on that strategy. Let's say you want to understand what is a short straddle. Okay, let's say you want to understand what is a short straddle. So you click on short straddle, you come and they will explain to you how do you implement the short straddle, what is the idea, why are you doing this, what is the potential losses that you can get. So this is a website that I can guide you to, guys. It's called the TradeKing.com, and it has a various diverse range of option trading strategies where you can kind of read up on them and get an idea of how to implement or execute these strategies. Okay, so this is the best that I can do. I can guide you to this very good website which talks about various kinds of strategies. What are the benefits? What are the risks about those strategies? Whether you should, what should for. So this TradeKing.com is a website that I can guide you guys to. So I have another question from, I don't know the name because the name is not there, and this person is asking me, is there a benchmark for volatility to define whether it is more or less? Yes, of course there is a benchmark, and it is called the VIX, the Volatility Index. Okay, so the Volatility Index, this India VIX, the thing here, this is a index which sort of gives you a sense of where volatility is headed. Okay, so let me open this. Oh, this is only daily. So the answer to your question is that there is a volatility index. It's called India VIX, and this gives you a sense of what is expected. What does the market expect in terms of volatility? But mind you, if you have an idea that you will look at India VIX to understand what is going to happen to volatility in the near future, and then you want to take a position on the option markets, don't do that. Why? Because the volatility index is already priced in the fact that volatility in the near future is likely to be high. And hence, people who wanted to take a position expecting that volatility would be high have already done so and have already taken their positions. And hence, you now are a late entrant. So volatility index you should not be trading on options, you should not be trading on volatility aspect of options by looking at volatility index, because volatility index in itself has already priced in the fact that options are trading at prices higher because people are expecting more volatility, right? So you'll be behind the curve if you use the India VIX to trade on options and expect to gain from volatility, where the volatility will go up or go down. Okay, so I have a question now from Jay, and he's asking me how to decide if you're buying the put or the call option at the right price. Can I explain this to him with an example? All right, so Jay, let me go back to this main page. This is the most important page if you want to be trading an option. This is called the option chain, and on the middle, this middle line that you have the strike price. Okay? On the left-hand side you have the calls, on the right-hand side you have the puts. Now let's say you want to trade on this 8,000 option, 8,000 call option. Okay, so essentially this option here. Now, the first thing that you, when you trade an option, when you want to understand what should be the price of an option, the first thing that you have to ask yourself, the first fundamental question is this option in the money or is it out of the money? What does that mean? That means when it is a call option, whether the strike price is below the current market price or above the current market price. If the strike price is below the current market price for a call option, this is an in the money option. If so, this 8,000 is an in the money call option, whereas this 8,500 is a out of the money call option. For puts, it's the exact reverse. For puts, when the strike price is above the stock price, that is this 8,500, that this 241, this 8,500 is in the money, whereas this 8,000, this put option here, this 32.5, 32.45, this one here, this is out of the money put option. Okay. So the first thing when you do is when you want to trade an option is you want to ask yourself whether this option is in the money or is it out of the money. Okay. So let's say now you want to trade this 8,000 rupees call option. We know we have now asked ourselves whether this is in the money or out of the money. We have found that this is in the money. If it is in the money, then essentially the price of the option has two components. The two components are intrinsic value and time value. Okay. When an option is in the money, the intrinsic value is the difference between the strike price and the stock price. That means the intrinsic value of this 8,000 call option, and let me open this option. The intrinsic value of this 8,000 call option is the strike price, which is 8,000 here that you can see, the one here, 8,000, and the stock price or the index is 8261. So essentially, the intrinsic value of this option is 8261.75 minus 8,000, which is 261.75. This is the intrinsic value of the option. This is the bare minimum the option will be priced at. If the price of the option is below 261.75, then there is a clear arbitrage opportunity. So an option will never trade below its intrinsic value, never. If it trades, there is an arbitrage opportunity. It will never trade below the intrinsic value. Okay. So we know that the minimum will be 261. Then what we want to see is how much of time to expiry is left. We see that the time to expiry left is 29th of December till the expiry date is 29th of December. We have 18 days, 18 calendar days till the expiry date. So we have quite a bit of time. Based on this, there will be a time value premium, right? So because there is a lot of time to expiry, there will be a time value premium. This time value plus the intrinsic value is what gives you the market value, the premium, the option price, which is 303.20. So we see that the time value for this particular option is 303.20 minus 261, so which is about 42 odd rupees, or about 42 odd rupees, right? So this 42 odd rupees is the time value. So when you're trading options, you first look at what is the intrinsic value, you look at the last traded price, and you get a sense of what is the time value, and based on that you can figure out of what you think would be a comfortable quote that you would want to give. So this is how you try and understand what is the price of the option. Okay, so there is the intrinsic value part, there is the time value part. The time value is higher if there is more distance to expiry. If there's a huge amount of distance to expiry, the time value will be much higher. If there's only 2 days or 3 days left to expiry, the time value would be much lower. So this is essentially how you find out how you understand what is the price of the option. Now let me take you to the option which is, let's say, out of the money. Okay, let's say I get an option which is call option which is out of the money. So I get this 8,500 call option. Now this 8,500 call option is out of the money. Why? Because the strike price is greater than the stock price, and hence this call option is out of the money. Hence the price that you see here is only and only time value. Okay, so that is also so it's essentially in this case what you see is only time value. There is no intrinsic value for this particular option. It's only time value. So if Nifty does not reach 8,500 by the 29th of December, this thing will become zero. Okay, So that is essentially how you look at the price of options. The other thing that you need to keep in mind is that you know, the deeper the option is in the money, the higher will be its price. So you see that the price here is sort of, because these ones here on the call option side, these are in the money options. If you go from the top to bottom, you will see the price is decreasing. Okay, because the deeper the option is in the money, the more expensive it will be. Why? Because the deeper the option is in the money, the more sensitive it is to the movement of the underlying asset. Okay, and also the deeper the option that is in the money, the more intrinsic value the option has. Similarly, on the put side, you will see that the price is increasing because from top to bottom, we are going from out of the money to in the money. Okay. So that's essentially how you figure out the price of the option. Okay, Varun, you're asking me how can we analyze and make report of oil looking at a past 15 days traded. So I'm Varun, you have to explain what report are you talking about. I mean, you can do various reports. You can download the price and draw, you can draw returns, you can draw volatility, you can create many reports. You have to clearly tell me which report you're talking about. Okay, Ganesh is asking me how to calculate stop losses options. Ganesh, there is no science of calculating stop loss and option. It totally depends on the investor or the trader. A trader who can bear more losses will give deeper stop losses. A trader who is very tight will have smaller loss options, smaller stop losses. So there is no science. There is no mathematics behind calculating stop loss. It is completely from the perspective of the trader. So Varun, I'm not sure what do you mean by basic report. So essentially, let me try and give you a brief idea of how I work with prices. So whenever I am, firstly, my objective of what report I want to create, or what graph or what data I want to analyze, that is immediately clear to me what I want to. Then essentially how I do it is that I go and download the prices, and then on an Excel sheet or a CSV file. And then from there I compute the the daily returns, and using these daily returns I calculate whatever my particular report needs. If I want to calculate volatility over the last using, let's say, a Garch model, I try to fit a Garch model based on the returns that I see. That's essentially how I work with it. So let me try and see if I have a data which I can show to you. Just give me 1 second. So give me a minute, guys. I'm just trying to see if I have some data here or not. So yeah, Varun, this is what I found. I was working with some treasury bond, treasury and some volatility index data. And this is how I work. And essentially, I download the data here. Based on the data, I calculate the returns. So let's say I want to calculate, the returns. The way I do it is that, I calculate the returns on this side, let's say between the daily return so based on these returns, and then plot graphs or whatever. So these are essentially the treasury bond yield returns over the last I think 2 or 3 years, and this is how I calculate. And you see that these are returns. This is like a stationary time series. So this is how I work about it. Now, if you want to ask how exactly, if you give me a specific question of how to create reports, I can show it to you then. Otherwise, I'm not sure what basic report you're talking about. All right, so let me close this down. Okay. All right, so Jay is asking me what clues can we gather from the open interest before taking futures position in the stock. So this is a very good question from Jay, and he's asking me, what does open interest signify? So open interest is a measure of how many trades, how many open contracts are out there in the open. What do I mean by open contracts? So when one particular option seller comes and sells a particular option, and he sells to create the option essentially, and another buyer, so let's say there is a particular option seller, he has no other positions on the stock market, he comes to the market and he sells the option. Okay, so essentially he sells the contract, and somebody else comes and buys this contract. So in this trade that happened between the seller who sold the contract and the buyer who bought the contract, one option got created because the seller created essentially a contract by selling that. And hence the open interest in this option is 1. When you have a large amount of open interest in the option, that signifies that there is a lot of open positions in this particular option, right? So it signifies there's a lot of interest on that particular option. So we see that the highest open interest in this particular on the Nifty is on the 8,300 call option that has the highest open interest, and the 8,200 put option has the highest open interest. So that means there's a lot of trading that happened on these two particular options, the 8,300 call and the 8,200 put. So one thing, so the two things it signifies: A, there's a lot of interest on these particular contracts, and B, that there's a lot of liquidity here as well. So when you go and trade on these particular counters, on these particular options, you're unlikely to face any liquidity problems. If you quote a price, you'd probably get a buyer. If you quote a reasonable price to buy or sell, you'd probably get either a seller or a buyer, depending on what position you're trying to take. So open interest essentially signifies the amount of open positions that are there in that particular option. Okay, or in a futures. Open interest in the futures is also the same thing. Yeah. Right. So the other thing that you see that when there's a lot of open interest, so there's a combination between open interest and price movement, which can give you a sense of what has been happening in the market. Let's say if open interest is rising, so we see that the 8,300 open interest between Thursday and Friday, there was a increase in the open interest. So when you see increase in open interest and when you see increase in prices, that sort of gives you a feeling that there's a bullish sentiment in the market, because there's a lot of aggression where price is increasing and people are buying, there's a lot of buying pressure, and there's increased creation of open positions on the open interest side. So let me show this to you for the futures. So become more clear. All right. So we see that the open interest is about 1,71,51,255, and the change in open interest between Thursday and Friday was 2,85,975. And we see that there was an increase in the price of the Nifty futures. It increased by 19.45 between Thursday and Friday. Okay. Now, what does this signify? This signifies that there was a lot of buying pressure on the Nifty, and people were coming and buying. There were a lot of open positions that were getting created, and there was pressure on the upside. This sort of gives you a significant. This sort of signifies that there was a bullish trend in the market. Had the open interest been going up as they are going up now, and had the price been going down, that would mean more people are coming and taking positions on the futures, but the price is going down. That means there's a bearish sentiment in the market. Okay? So if open interest is going up and prices are going up, one could sort of get a feeling that there is a bullish sentiment in the market. If open interest is going up and price is going down, one could get a feeling there is a bearish sentiment in the market. Now what happens if open interest is going down and price is going up? If open interest is going down, if this change in open interest is negative, and if prices are going up, then what you're essentially seeing in the market is short covering, right? So people initially had short positions, they are now closing out their position, and that is what is causing the price of the options to go up. On the other hand, if you see the price of this futures is going down, and if open interest is going down, then what you're essentially seeing, if you see that open interest is going down and price is going up, you're essentially seeing short covering, okay? And if, so essentially that's what it is. If price is going up and open interest is going down, you're essentially seeing short covering. If price is going down and open interest is going down, so if this price of the futures is going down and open interest is also going down, what you're essentially seeing is profit booking. So there are four categories, okay? Dividing it into four categories. Open interest going up, price going up. That is a bullish trend. Open interest going up, price going down. That is a bearish trend. Open interest going down, price going up. That is short covering. Open interest going down, price going down. That is profit booking. So these are the four categories on which you have to try and look at and see what is happening in the market. This is purely to get a sense. This is not, this is by no means a sure shot thing. There are no sure shot things in the market. This gives you an idea of what is likely to be happening in the market. However, this analysis should only be done with futures contract. You should not be doing it with option contracts, because option contracts, there are many more parameters out there, and that might be causing the price of the options to going up or going down, and hence you should not be doing this analysis with option prices. It's only with futures prices that you do this analysis. Okay, so that is essentially how you look at open interest and try and understand what's going on in the market. So Nirav, the question that you asked, I exactly answered that question, but you understand that by looking at the price of futures and rather than the price of options. It's by looking at open interest and the futures price to get a light of what is happening as a trend. Harsh, you're asking me, can we say the highest open interest in put and call is giving us a resistance and support level as many have sold options? So Harsh, resistance and support has something to do with technical analysis. I am by no means a technical analyst. I know nothing about technical analysis. In financial academia, you have nothing called technical analysis. So I cannot give you an answer about resistance and support levels. All right, so I'm waiting for some more questions. Please type in your questions. I'm sure there are some questions you had on option Greeks and stuff like that. So there are more complicated things. Please feel free to ask me any question on derivatives. So Sachin is asking me how to use option groups efficiently. And Jay is also asking me about terms like alpha beta. Jay, alpha beta has got to do with capital asset pricing model. That those are not Greeks related to options. I know what you mean. You're essentially talking about delta, gamma, vega, theta, and rho. All right. So let me try and explain to you from a layman's perspective what option Greeks are about. So if you take a particular option, let's say let me take a particular Nifty call option. Let's take this 8,300, the one which has the most number of open interest. All right. So if you look at this call option, okay, remember that there are several factors. As I said previously, there are several factors which affect the price of this particular option. Okay. One of them is fundamentally the price of the underlying asset, which is the Nifty index, the 8261. There are other parameters as well which affect the price of this particular call option, this E3 that you see on the screen. And the other parameters that affect the price of this option is our time to expiry. So we have about 18 days left to the expiry. That is one. The other thing that affects this is volatility. Okay, if something, if we are expecting a huge announcement coming forward in the couple of 3 or 4 days, you can expect the price of this option might go up. Okay, so there are various parameters which affect the price of the option. What the Greeks help us do is that the option Greeks help us understand or quantify the effect that each parameter has on the price of the option. Now let me not go into the mathematics of it, because the mathematics is obviously a little bit complicated. And let me try and explain to you from a simple layman's perspective what this option Greek is. So let me take the first option Greek, which is the delta. Essentially what the delta does is that it answers this simple question. If this Nifty price goes up by 1 rupee, so this 8261, if this becomes 8262.75, then how much will this 83 change by? That is essentially what the delta is answering. For a 1 rupee change in the price of the underlying asset, in this case the Nifty index, what will be the change in the price of the option? That is what the delta is answering. Then there's the other important option Greek, which is the Vega. Now what does the Vega answer? The Vega answers that if there is a 1 percentage point increase in the volatility, we see that the implied volatility is 10.3. If we anticipate another increase in the volatility from 10.3% to 11.3%, then how much will this 83 change by? That is what the Vega is answering. Then there is the theta, which is the option Greek, which measures the distance between the time effect of the option, the time K value of the option. What does that mean? The theta tells me that today is the 11th of December. In 1 day, let's say on the 12th of December, by 1 day passage of time, if everything else is constant, that means this implied volatility does not change, this Nifty value does not change, if nothing changes, ceteris paribus, that is the Greek word for all else remaining constant. If everything else is held constant, then a 1 day advancement, a 1 day move towards the expiry date, what will be the effect on this price of this option? That is what the theta is measuring. Then there is the gamma. What does the gamma do? The gamma essentially measures, okay, so when I said delta, what did I say about the delta? I said that the delta for a 1 rupee change in the Nifty index, how much will this 83 change by is essentially what the delta is measuring. But the effect of this change of the underlying asset, this 8261 to 8262, the effect of this change on this price is not linear. What do I mean by that? I mean that when it goes from 8261 to 8 to let's say 81, then the effect of this change on this underlying on this option price will be different from the change from 8281 to let's say 8300. So the effect of the change of the underlying asset on the price of the option, that is also changing. And gamma measures this curvature. That is the change in the delta. How much does the delta change by? Gamma can be a bit complicated. So as option traders, I would advise you not to think about the gamma a bit. As option traders, you should probably only look at 3 parameters. As beginners, you want to understand options and trade in options as beginners from a scientific perspective. Only look at 3 parameters as to begin with. Later on, you can understand the other parameters that are there. Look at Vega. So firstly, most importantly, look at delta. That is your most important parameter. Then look at theta. That is your second most important parameter. Then look at Vega. That is your third most important parameter. That is the effect of the change of the price on the option, the effect of the movement of time on the price of the option, the effect of implied volatility on the price of the option. These are your 3 parameters. Now you can find several websites where you can calculate this, given you have to enter the expiry date, you have to enter the strike price, you enter the price, you enter the implied volatility, you enter the interest rate, you can take this as 10%, and you calculate your deltas. These 3 parameters is what you should be looking at. Let me give you a hint about the delta. One hint about the delta that you need to keep in mind is that an in-the-money call option. What is an in-the-money call option? An in-the-money call option is where the strike price is equal to the stock price. So approximately this 8250 is an in-the-money call option because 8261 is the price of the Nifty, right? So it's 8261. So approximately this 8250 is the in-the-money call option. The in-the-money call option has a delta of 0.5 approximately, all approximately. Approximately the in-the-money call option has a delta of 0.5. That means if the Nifty goes up by 1 rupee, this 114 will go up to 114 rupees 50 paisa, approximately. Okay. So that is essentially what you need to. So this is essentially what okay. The other thing that you have to keep in mind is that for a call option, the delta is increasing as you go up this line, and the delta is decreasing as you go down this line. And that is why these options are so cheap. So you see this 8,500 option, this is only 18 rupees 70 paisa. That is because this is very less sensitive to the price of the Nifty. If the Nifty goes up by a lot, this will go up by let's say 2 rupees. But if the Nifty goes up by 50 rupees, this will probably go up, this 8,000 option will go up, it would probably go up by 60 rupees. So, no, sorry, so not 60 rupees, something less than 60 obviously because the delta is much lower. So the delta is decreasing from top to bottom for a call option, and it's the exact reverse for the put option. The delta is increasing from the top to bottom, from top to bottom of this column for the put option. So this is essentially a sort of a brief explanation of how to work with delta, how to work with Greeks. Look at the delta, look at the theta, look at the gamma. Look at the delta, look at the theta, and look at the vega. Look at these 3 things to get a sense of how these 3 parameters will affect your portfolio. Okay. All right, so Harsh is asking me, is it possible that different brokers offer different margin accounts? Yes, Harsh, it is possible. I think many brokers offer different deals to their clients, and different brokers can offer different margin amounts to their client. But the margin amount that they offer is a minimum which is set by the exchange plus something that they additionally want, and the additional portion is where they can give you a little bit of a leg room, whereby they can ask you much lesser than what other brokers might charge you. So Varun, I just gave you an explanation about option Greeks. I mean, in an international market, it's the same thing. It's the same principles that are being followed. You look at the Greeks to understand what is your exposure to the various parameters which affect the price of the option. Nirav, I cannot recall a site where you can do that, but if you Google, calculate option Greeks, I'm sure you'll get hundreds of websites. It's very, very popular. So you can find hundreds of websites. Okay, please type in more of your questions. Anand, I just explained the impact of delta. So delta is essentially measuring the impact of the underlying movement in the underlying price on the price of the option or the premium. So I just explained that. I'm not sure what is there on the curriculum. My sense is that there probably is a bit of a mock trading on the curriculum, in the curriculum. So Jay, I'm not sure I completely understand your question. So when is a bull spread or a bear spread in options bought into for any stock? So you do a bull spread when you are bullish on that particular underlying asset, and you do a bear spread when you are bearish on that particular underlying asset. So I mean, that's a pretty straightforward answer, right? So I'm waiting for some more questions. Please feel free to ask, type in your questions. Anand, so there was a previous question on stop loss and target as well. So the thing is that stop loss and target, there are no scientific ways of calculating it. It totally depends on the trader. So there is no science behind calculating a stop loss or target. So there is no mechanics, there are no models to calculate stop loss and target. It totally depends on the trader, on what he has, what his beliefs and stuff like that. So this is more of a question with regards to perspective. What is the perspective of the trader on that particular market, on that particular counter, or in the market? So I have a question from Kanan, and you're asking me to explain bullish vertical spread using calls and puts. So let me go here, and so let me see, which one are you talking about? So I'm not sure what do you mean by the bullish vertical call spread. So, but there are call spreads, which is the essentially what we call the bull spread or the bear spread. The bear spread is the put spread. Okay, so so in a particular call spread, you essentially buy a particular put option at a price. So let's say you want to implement a call spread, a bull spread using calls on the Nifty index. So let me show you how you will do it. So if you want to implement a bull spread using calls, the way you would do is this. You would go and buy the, let's say, the 8,300 call option. This is the most liquid call option, okay, at 83 rupees. And you would go and sell the 8,000, I don't know, let's say 500 call option at 18.7, 18 rupees 70 paise. So essentially, you bought this 83 call option at 83 and you sold this 1870 call option at 8,500. 8,500 call option, 1870. So effectively, the difference that you paid is in the range of 65.30. That's essentially what you've paid. Yeah. So 65 rupees odd, that is what you pay effectively because you get 1870 for selling this. Now, at the expiry or during in a couple of days, if the Nifty appreciates, then you are likely to make more profits on this 83 call option than the loss that you make on this 8,500 call option. When Nifty goes up, obviously this will go up and this will also go up. This 83 will also go up and this 1870 will also go up. But this 83 will go up more than this 1870. And hence you will likely make a profit. Then you can close out both your positions and take out your profit. If you hold on this position till expiry, then as long as the Nifty stays above 8,363, because you effectively paid 63 for this particular strategy, if the Nifty ends above 8,363, you make a profit. Okay. If the Nifty ends above 8,000, if the Nifty exactly ends at 8,500 on the 29th of December, if the Nifty exactly ends at 8,500, then the profit that you make is 127 rupees. This 8,363 minus 8,500. 8,500 minus 8,363. I hope you understand why am I keeping adding the 63, because the 63 or 65, I'm sorry, so 65 is effectively the difference between these two options. And that is your best case scenario. Okay. So this is essentially how you implement a bull option with calls. Okay. If you want to implement a bear option, a bear spread with puts, you essentially do the same thing, similar thing on the put side. So you buy this 8,200 put option, and let's say you sell this 8,000 put option. So you buy this at 74 and you sell this at 32.45. Okay. So again, the same logic applies here, and this is how essentially how you implement this particular bull bear spread with puts. Now, what if you want to implement a bull spread with puts? If you want to implement a bull spread with puts, what you could do is that you sell this 8,200 at 74 and you buy this 8,000 at 32. That implements a bull spread with puts. Similarly, if you want to implement a bear spread with puts, you sell this 8,300 and you buy this 8,500 at 1870. You sell this 8,300 call at 83 and you buy this 8,500 call at 1870. That implements a bear spread with calls. So I hope I've sort of answered your question in regards to bull spreads and bear spreads using both calls and puts. Vishnu, yeah, I think these lectures are recorded. You can definitely access them later and listen to the whole lecture again. So I think that's certainly possible. Any more questions? So if you have some more questions, please write it down there. I'll wait for 5 more minutes to get some more questions. If there are no more questions, then we can end this webinar. If there are some more questions, please write them down. All right, that's it. If there are no more questions, then let's call it a day. I thank everybody for joining in and asking their questions. I thoroughly enjoyed answering your questions. If you have any more questions which you want to ask me in private, please feel free to email me. I guess you guys know my email ID. If not, I'll type it in again, and please feel free to email me whatever questions you might have regarding derivatives. So I'll type in my email ID on the chat box. Yes, so thank you everybody for joining in. So, and have a good day, right? Again, you have my email ID on the chat box. Please feel free to send me your emails regarding any further queries that you might have. Right. Thank you, everybody. Thank you so much. Goodbye. Have a good day. Bye.